All right, thanks for joining us here. My name is Aaron Fragnito, and I'm co-owner of People's Capital Group. I'm going to do about a 45-minute presentation tonight about properties that People's Capital Group owns and is renovating and repositioning in North Jersey. We're going to talk about property in Paterson, New Jersey and Passaic, New Jersey, two very up-and-coming cities we've done a lot of investing in for years. And we've been able to do very well with our investor group there. And so we'll focus on two buildings. We'll break them out tonight. And this is not a solicitation for funds. This is not tax advice or legal advice. We're just going to discuss how People's Capital Group did their due diligence on these properties, purchased these properties, used capital from our group of investors that are qualified and passive investors, so they don't have to do the work or deal with the mortgage or the analytics of the property or the due diligence or management or turnovers and repositioning of the property. So we focus on all that, and we'll talk about how our investors or what their experience is like and how our process is through repositioning apartment buildings in North Jersey. So our case study number one tonight is 463-465 Summer Street in Paterson. Case study number two is 196 9th Street in Passaic, New Jersey. I see more people jumping on here as we go. Always good to see. I encourage any questions as we go along, type them in the Q&A. So if you put your mouse over the Zoom box, a Q&A option is there. You can go ahead and type your questions in there. And if any process, through this process, as we're explaining how we reposition these apartment buildings and work with passive investors, if you want to go over to peoplescapitalgroup.com and fill out that qualification form, that's the step to getting qualified. So we're going to break into it here tonight. And as more people jump on, we'll talk about here how it works. So how do we find these buildings and why do we focus on New Jersey and how do we make them better properties, better assets? Well, first, we need to purchase a discounted property, right? You make your money when you buy in real estate, and we'll look at sometimes over 400 properties to buy one. So we'll do a very long length of due diligence, multiple levels of due diligence to decide which is the best property to purchase on, and then bring that opportunity to our investors. And we'll talk about two specific opportunities tonight and break those out. Step two, we improve the units, we increase the rent, we lower our expenses. It's not rocket science, but it is complex in the details, right? The devil's in the details, they say. So we have developed our own management company, in-house management, that allows us to improve these units faster, to get these projects done in a more timely manner, to increase the rent, to achieve our goals on the reposition. Because we own the management company, that's our own staff, we're not at the mercy of a third-party management company, which makes it easier and faster to complete these projects. Step three, create positive cash flow from the property, complete a cash out refinance. That's when we're going to improve the value of the property by improving the units, renegotiating leases, lowering our expenses, and now the property is worth more money. Ideally, it's increased its cash flow as well. The more net operating income a building is earning, the more it's worth. That's how commercial real estate is appraised. So we do a cash out refinance by paying off our old loan, taking a new mortgage, a larger mortgage amount, and paying off the old debt, safe amount of debt, low interest debt. The bank's only going to give us as much as the property can afford to handle. But that allows us then to have a lump sum of cash left over, and the investors can split up this cash. So that's a great opportunity. It's called a cash out refinance, also known as the buy, renovate, refinance strategy, right? But we execute this on a large scale. And that is our goal. That's our whole business model here at People's Capital Group. So that the two properties we're talking about tonight are in the midst of the buy, renovate, refinance strategy. So here's the team. That's Seth Martinez, my business partner on the left there. He's in charge of the New Jersey acquisitions, working with the New Jersey management company, completing due diligence on those acquisitions, overseeing our New Jersey management company. And of course, just general oversight of the company as well, keeping our costs low and keeping a lean, mean machine moving here at People's Capital Group. I'm Aaron Fragnito. I'm in charge of Vermont acquisitions. I actually live in the Okemo Valley. My wife and I moved up here about a year and a half ago to focus on building out our holdings up here, with People's Capital Group. So our investors now partake in hotels up here and other short-term rental properties that produce strong cash flow, which is a nice counter to our New Jersey investments that produce strong equity growth, but lower cash flow. So I, of course, focus on fundraising, due diligence of both New Jersey and Vermont properties, overseeing the PCG Vermont, and general marketing and branding. If you're investing with People's Capital Group, or maybe you found us and you came to one of our webinars and came to one of our events in the past when we were doing it in-person events, you may have met me, Aaron Fragnito. I'm more out as the branding marketing face of the company. And if you're investing with us, then you're going to get monthly updates from me, that very in-depth updates. And I really take pride in educating our investors as they invest with us. And we call it the Learn and Earn program. So it's a lot of fun to just teach our investors what we're doing as they're earning from the properties. And of course, all that information we're giving them is part of the investment. It's all included with the investment. That's part of our promise to our investors. So here we have Lena Delgado. She's part of New Jersey Property Management, PCG Property Management. She focuses on running our property management company and managing our staff there, dealing with our tenants and all the shenanigans of property management. It's a tough job. She's also oversees the leasing and the New Jersey office management as well. So there's a lot of moving pieces with management. You need good people under you, you need effective people working for you. And Lena is definitely the cream of the crop. Robert Grulich, our CPA, he works essentially as a CFO in our company, although it doesn't have that the title necessarily, but he really guides us on the accounting and tax filing into the business. He handles his staff comes in, does the bookkeeping for our company as well. So we have a whole third-party CPA firm, Grulich and Hoekstrik, CPA firm. They're out of Montville, New Jersey. Great firm. A lot of our investors end up working with them because they're so good with small business owners and real estate investors. So they do all of our bookkeeping, all of our tax prep, all of our tax filing. We really love working with Grulich and Hoekstra out of Montville. And it's just so nice to have a separation of powers. Not only is that better for our investors, but it also gets the tax filing done more quickly, the bookkeeping and the financials out more quickly. And of course, you want the professionals focusing on what the professionals are good at. All right, so let's break into our first case study here. Again, as we go along, I see more people jumping on. Always good to see. We're also live on Facebook. Maybe you're part of our group on Facebook, Real Estate Investments. It's our Facebook page, and then our Facebook group is Real Estate Group. Maybe you found us there, found us on YouTube, and you're jumping on from that. Or you've been investing with us for years, or just following us for years. So we're glad to have you on the presentation here tonight. We're going to talk about 463-465 Summer Street in Paterson, New Jersey. Now, Paterson, New Jersey is a very up-and-coming city. You really have to know what you're doing in that city, like any city. You have to know your areas, your blocks, and your good areas and areas that are more up-and-coming. And what we focus on is buying around the downtown area. We also like some of the outskirts of Paterson and just different areas along Market Street there. So this property is right near the high school, right near a lot of development. What we've seen with Paterson is they've green-lighted a ton of development. Paterson is more bullish and easy to work with development and rezoning of real estate than Newark and a lot of other comparable cities in New Jersey that are, it's hard to develop in Newark. It's kind of like an old boys club, and if you're not part of it, it's hard to get developments approved there. Paterson's different. Paterson is open to development. There a lot of buildings are in the air, a lot of cranes are in the air, a lot of things going on there. Every building they build gets leased up for even more than they're predicting. The values in Paterson have been very good for us. So we're bullish on Paterson, New Jersey. Now, there are parts of Paterson you may not want to invest. There's definitely some areas that haven't yet seen any type of improvement, and that there's challenges that Paterson faces with violence and whatnot. You're going to be dealing with any inner city in America. But if you know how to invest properly, how to buy the right buildings, the right price in the right areas, and improve that building and kind of make a good ecosystem right in that building where it's safe to live, it smells nice, you're comfortable living there, bringing your friends and family over, and that's the type of environment we try to create in these mismanaged apartment buildings. So this deal was created, not found. We always say great deals are created, not found. What that means is Seth will talk with these property owners for years sometimes, and he'll just call them up and chat with them and maybe not even talk about the properties sometimes, but over time he builds rapport with them, and they eventually agree to sell us the property for a reasonable price, ideally a very attractive price for us. And of course, To find these individuals, we do tons of direct mail that puts us in contact with the owner. It has gotten really hard, though. I have to say, our direct mail campaign recently has been a big waste of money, but it is really all about having good relationships in place. These days, we're finding deals from landlord relationships we already have, brokers and wholesalers we've been working with for years. I think the direct mail almost, wouldn't even suggest doing that right now. It's so saturated in New Jersey, it's hard to find a good deal. Having our boots on the ground, having over a decade of experience for both Seth and I working in these industries, in these markets, allows us to get access to these properties for a decent price. The owner is old and retiring, mismanaged building, classic mismanaged building, worn out landlord, exactly what we're looking for. Needs a little bit of lipstick on a pig is the technical term, some renovation of the property, and we're doing that. Actually, the renovations are mostly complete. We'll go over the renovation in a second. So Seth built rapport with the owner, negotiated a good price on the property. The property didn't have a green card. That's something we're going to complete very shortly. It takes a little while to get a green card. What a green card is in New Jersey is a state certificate that is required by landlords to complete every 5 years. Now, it's one of the most ambiguous things in New Jersey. There's no real enforcement of it, but then sometimes they enforce it and then they'll start fining you without telling you. It's a very difficult bureaucratic system to work with, but you just want to try your best to cooperate with the green card system in New Jersey. It's for any building with 3 units or more, requires a state inspection every 5 years. So if you have a building that's 3 units or more and you're saying, what the heck, a green card, and you've owned your building, well, maybe you've owned it for 6 months, but the last owner didn't get a green card ever, then you may want to check that out. There could be big fines to the property from the state that you're not even aware of. So green cards are an important part of owning larger multifamily housing in New Jersey and understanding how that works. The rents were below market value and the building needed work overall. It's 10 apartments and 1 storefront. So here's the structure. Here's the acquisition structure of the property. 58% of the ownership is owned by passive investors. These are investors that brought the capital to the table for the down payment on the mortgage, the closing costs, and the construction costs. So these investors are passive investors. They don't have to do anything day in, day out. They get monthly updates explaining what's going on with the property, the good, the bad, the ugly, the challenges we're facing, and the solutions we have. So they're learning as we go along with the property, and they're earning passive cash flow checks as the project gets complete and the property starts cash flowing. It'll produce quarterly cash flow checks for these investors. And ideally, when we complete the cash out refinance, looking at a nice large return of their investment that's tax-free. We'll talk about why that's tax-free money at the cash out refinance a little later in the presentation. So here's the breakout. 58% is owned by the passive investors, 42% is owned by People's Capital Group. Now, we don't take any overriding asset management fee. Our property management fee is about 2/3 of what your average property management company would charge. So we charge a discounted property management fee, and we really don't run a fee-based business. Seth and I make our income from ownership of real estate. That's a great tax strategy, but it's also a fair way to do it, because that way our investors feel like we're in it together. We're in it to win it. Seth and I have to complete the project successfully, renegotiate leases to top dollar, get our expenses down, do everything on the checklist to get the property properly cash flowing, to get paid ourselves, right? To get that cash flow ourselves, to get our 42% of the cash flow, and to get that refinance, right? So we want to make sure the property's properly renovated, cash flowing for top dollar, for it to properly appraise. When we go to do our cash out refinance, the property has to appraise at that dollar amount we need it to get at. So our goal is in sync with the investors, and therefore we've had a lot of success, and we tend to under promise and over deliver. We've generally hit our targets, if not hit about 10% more than our targets historically. So we've done pretty well there historically with our passive investments and hitting our targets and projections. So we raised $406,000 for this acquisition. Not a large fundraise for us. We are raising right now about $1.3 million for an acquisition, and we have another one coming up with around $1 million raise. We created a Reg D 506B for this, and we filed that with the SEC. And that allowed us to work with sophisticated and accredited investors. So that means we can work with people that didn't have to be necessarily multimillionaires, right? They could be people that are self-directing their IRA into real estate, or their solar 401k into real estate. They just had to have the minimum investment amount of $30,000, understand the investment opportunity, have some experience in the real estate industry, maybe owning a home or something like that, and have excess savings and excess funds coming in to not to live off the investment. And those individuals would qualify as sophisticated investors. So there is a vetting process that is not too painful. We try to make it as easy as possible for our passive investors to get qualified, but there is a process, and we do accept sophisticated, which are beginning investors kind of getting started, non-millionaire investors, non-accredited investors, are sophisticated investors in the eyes of the SEC, and we can accept those investors. We can also accept accredited investors, millionaires essentially. We work with many of those as well, but we pride ourselves in running a 506B for our acquisitions and allowing ourselves to work with sophisticated and accredited investors, small investors getting started, and big investors with millions with us as well. We acquired a $723,000 mortgage for this. This was personally guaranteed by Seth and I, so our investors don't have to. So we signed for the mortgage, so our investors don't have to. It's very important to recognize that when you're investing in a syndication like ours, we're taking a huge amount of risk signing for that mortgage, and that's a lot of risk taken off our investors' shoulders to allow them to limit their risk to their investment. I'll say, okay, so here's the timeline to close and reposition the property. The project is ahead of schedule. We bought the property, January 2019. Seth connects with the owner and builds rapport. So, we sent out direct mailing probably months before that, but, he finally called on the letter, and Seth connected with him and started building a relationship. July 2019, so 6 months later, the seller signs a purchase contract for $965,000. So we bought an 11 unit in Paterson for $965,000. Units in Paterson right now that are comparable are appraising around $150,000 a unit or so. So I don't think our value is up there necessarily just yet, but we got a good price on this one. Took 6 months to put under the contract, but then by June 2020, okay, so we went from July 2019 to June 2020. Now, this is not that common. It normally doesn't take that long to close, but this is a good story. It took many months to close on this. There were delays from the seller's title issues. So the seller, I guess to avoid taxes years ago, had transferred the ownership of the property to his deceased wife, who is now deceased, which complicated things even further. And it had to be essentially transferred back to his name, but there were tax consequences to doing that, and he didn't want to pay them and asked us to pay his taxes, which was a firm no. So there was some negotiating back and forth, and he didn't get what he wanted, and that's why it kind of took a while here to close. But we did eventually close on the property, and we did get that good price. We did not end up paying the seller's taxes, but you could see here, it took nearly a year for us to negotiate that with the seller, get a clear title, get a fair transaction completed. And you have to be patient, whether you're the investor or the operator in this case. Everyone's got to be patient, because the bottom line is good deals take time and things take time. Real estate closings can take time, and hopefully not, in this case, 11 months is a case study that's pretty interesting, being that look how challenging that closing was, right? But normally a closing will be about 3 to 6 months at most. That's always our goal, is to get it closed in about 3 to 4 months, really. Okay, so July 2020, so 1 month later, PCG then begins, of course, so as soon as we buy it, we begin repositioning the property. It's a 2 to 3 year project we project. June 2021, reposition ahead of schedule, nearly complete. And update here for of course, September 2021, we are essentially 90% complete with our project here. So we are ahead of schedule, and we are ahead of the target on the renegotiation of leases as well. Reposition performance here. So our initial rent roll of $10,900 when we bought the property, we knew we wanted to get our rent roll up to about $13,800. The current rent roll after year one is $12,700, and actually it's a little bit higher than that as well. We just need to update that here. So it's actually just a little bit in the 13,000 mark there, just below that 800 mark. So we're really even be figured with the contingency. Construction is ahead of schedule. That's good news. 5% annual forced equity growth. Our target is, we've done much better than that. So we assumed, we targeted a 5% annual forced equity growth. Okay. Forced equity growth is the equity we control by renegotiating leases, making physical improvements to the property, lowering our expenses. We can control that. We can force our equity up, right? That's called forced equity growth. We targeted 5%. We've done far better than that. We also assumed a 1.5% natural market appreciation. So we assume the market would just naturally grow by about 1.5% a year. We assumed inflation would just kind of naturally keep the market growing at that 1.5% a year, which is a pretty safe assumption. If you look at inflation, it's been growing at 2% a year for the last 100 years. So we were very conservative. We were way off on that. The market's done far better than 1.5%. I'm not even, I'd have to look back. I believe Paterson grew around 8% a year last year, and probably is doing around the same thing right now also. So inflation as well is encouraging that. So our natural market growth was multiple times better than our assumption, and that's good. We want to under promise and over deliver, and of course we hope that growth continues, but not too strong. We hope it simmers down a little bit so we don't grow too fast, of course. So here's our total target returns for our investors for years 1 to 5 for this 11-unit property here in Paterson, New Jersey. Cash on cash return here, our target is a 49% once we complete this refinance. So we bought the property for a good price. We're almost done improving the property and putting in tenants for top dollar. And after we have a good history there on the property, in about another 2 years, we're going to refinance the property. And we are on target to probably do better than this, but let's assume we hit our target here, that the investors would expect about a 49% return on their investment at the refinance. Now, the greatest thing about this refinance strategy is that it's tax-free income if our investors stay invested long-term with us in the property. Now, the reason it's tax-free income is because we're not selling the building. It's not cash flow from the building. It's debt. Now, it's debt that Seth and I are going to sign for. It's healthy debt. It's low. Nice. They can, the investors also have the option to exit at the refinance. Okay, now you can get back your initial investment, keep the funds earned from the refinance, keep the funds earned from the cash flow. However, you're going to be taxed, then capital gains tax will take effect for the funds you earned on the refinance, the cash flow, and the tax depreciation has to be returned. So exiting the investment is a poor tax strategy, but it's a great option for investors that want in and out of the investment. Most of our investors stay invested long-term because they understand that we're going to eventually do a 1031 tax deference. We're probably going to refinance buildings. So we very long-term. So this has allowed us to build a lot of wealth for our investors as well. They All right, looks like we had a little issue there. Share our screen. Just want to make sure everyone can jump back on. Sorry, I lost my internet connection there, but it looks like it came right back. So we're still going. Looks like everyone's still on here. I was just talking about the tax benefits of the refinance strategy here. And of course, we have tax depreciation. So in this case, we expect to have more tax depreciation than cash flow from this property. And that allows our investors to not pay tax on that cash flow because they can use the tax depreciation to write off the cash flow. So if you add up the tax depreciation, the cash flow from the refinance, you're looking at 86% New Jersey on Summers. Okay, so here's our next case study, number 2 here. This is 196 9th Street in Passaic, New Jersey. Now, this is a smaller property, but I like talking about smaller real estate syndications because, quite frankly, there's not a lot of people syndicating 6-unit properties in Passaic. They just haven't figured out how to do it. Their costs are too high. So we've figured out how to syndicate smaller properties. It's not really our preference. The minimum size we buy is 6 units, but it is a great deal. The numbers are great. Everything's panning out very nicely on it. So we're going to talk about this case study tonight. And this is a good inspiration for investors with smaller properties because you can syndicate smaller properties. And our syndication does focus on 6 to 50 unit properties in New Jersey. And to learn more about that and get qualified, you can go to peoplescapitalgroup.com. But let's break into this property here. There's a 6-unit. Again, great deals are created, not found. What that means is when we first start talking to a seller, a lot of times they're like, I want $1 million for the place, right? And they want way too much. So you build a relationship with them, and over time, they trust the way you do business more. We show integrity. We've done over 250 transactions together, Seth and I. We've bought and sold so much piece of real estate, wholesaling, fix and flips, apartment buildings. We've raised millions and millions of dollars and worked with over 50 private investors. So a lot of landlords like learning about us, like working with us, and as they get to know us a little bit more, they want to do business with us. And we say, okay, that's great, but we're going to need the property for this price. And here's the reasons why you should sell to us for that price. To find this owner, we found them through direct mail. Once again, there was kind of a different era. This was 2017, 2018. Direct mail worked a lot better then. I'd probably keep your money in your pocket for now. That's not a great way to get deals, but hey, you can keep trying it. We find most of our deals through our relationships right now because the market is so hot. It is hard to find a good deal, but we actually have a really good deal right now out to our investor group. So as an old owner, a classic example of a worn out landlord, retiring, ready to sell. Poor guy was a Mets fan as well. Seth built rapport with the owner, and he was able to negotiate a good price with the owner there. And again, it had no green card. Okay, green card is required. A state inspection that's required for 3 units or larger. Buildings that have 3 units or larger in New Jersey. So the rents were below market value, and it needed some cosmetic renovation as well. So 6 2-bedroom apartments here, not a huge property, but a nice opportunity for us that we were able to purchase for a good price. 45% was owned by the passive investors, 55% is owned by People's Capital Group. Now, we normally don't do a structure like this. In the acquisition we're doing right now in Rahway, it's more of a 35, 65 or so structure on that, with 35 going to People's Capital Group. And, so what we see on some properties, though, it does allow us to structure it like this. And in this case, the property there was so much meat on the bone, we were able to structure it as such and really get still great returns to the investor. And we are hitting above our targets on this as well. So for this acquisition, we raised $164,000. And we were able to create a 506C. We accepted 1 credited investor for this. And this is a good example of a deal where we had one of our larger investors come in, right? And we work with big investors that have millions of dollars with us, and we work with small investors that just have the minimum of $30,000 with us. So in this case, different than the first deal we looked at, where I had a number of smaller investors. In this case, I had 1 large investor come in with $164,000. So we created a Reg D 506C because we only needed to accept accredited investors in that case. Seth and I acquired a mortgage of $337,000 by People's Capital Group. We signed for the mortgage so our investors don't have to. I see here more people are jumping on, which is good to see. If you have any questions as we go along, put them in the Q&A. And I always encourage questions. I'm going to answer all questions at the end. And the Q&A is if you put your mouse over the Zoom box there. So here's our timeline to close and reposition this 6-unit in Passaic, New Jersey. The project is ahead of schedule. In August 2018, Seth connected with the owner and built rapport. By October of 2018, the seller had signed a purchase contract for $450,000. So again, here you can see it takes time. You know, it's not like we're knocking on the door in August and getting a contract signed. It doesn't work like that. It's a process of when you're buying commercial real estate like this. You know, these owners have been managing it a lot of times themselves for 20 or 30 years. And they have a real connection to the property, but they're looking forward to selling it often to a company that's going to really take care of it the right way. And they'll say that. So by October 2018, he had signed the purchase contract for $450,000. If you know anything about Passaic real estate and 6-unit values there, you'll know that's a pretty good price. So we locked this one up for $450,000, a nice 6-family in Passaic, you know, turnkey, fully occupied, and it wasn't in bad shape. It was just outdated, and the rents were below market value. Really good price, really good price. Make your money when you're buying this business. January 2019, PCG closed on the property and began repositioning. So you can see there, it took a little bit of time to close on the property, get the mortgage together, complete our due diligence, get all the right permits and whatever needs to be in place to close properly, and insurances. And of course, then we started the renovations. And by March 2019, we had our first completion of a successful cash for keys move out. Okay, so this was a great example of a property that was fully occupied with long-term tenants in a town with rent control. So first of all, you have to really navigate the rent control and understand it very well. The rent control in Paterson is different than the rent control in Passaic, which is different from the rent control in Morristown, right? So Elizabeth, Newark, it all changes in every single city has different rent controls. So it's really complicated in New Jersey, and you really need to know what you're doing in all these different markets. And that's why it's important, you know, we feel, to keep investing in a lot of the same markets. And that's why we bring a nice value to the table in knowing these markets well. So we negotiated cash for keys with tenants. That means their rents are way below market value, but they really aren't all that happy living in the unit anyway. It's kind of outdated and they're ready to move. And we say, okay, how about $1,000 and $2,000 off? Sometimes we go up to $3,000 or $4,000. I believe in this case, we worked out about a $1,500 payout or so to the investor, and started moving out tenants for cash for keys. That's an amicable exit. That allows the tenant to get back their security deposit, get some move out money, feel comfortable moving out. They're not being, you know, evicted or anything like that. It's an amicable situation. We give them time to find a new place. And at the end of the day, it's better for us because we are left with a unit that's in good shape and well maintained. Generally, they're not going to, you know, steal the kitchen sink on their way out. And we essentially don't have to deal with eviction court or all the costs and the time with that. I mean, right now with COVID, evictions are really tough. They really just started again. So you want to avoid evictions at all costs. We've avoided evictions through this pandemic by helping tenants with connecting with them with government resources, nonprofit organizations, and different ways to help them pay the rent. That really helps us in turn and helps the tenant. And we've guided our tenants to those resources. And through this pandemic, we've held a good, strong collections on our buildings. And that's been great for our investors as well. So by working with our tenants friendly, by being a friendly face, by being a source of a resource for them, a guiding light that they can trust, and ideally help them, work with them. We've lost your job or you've gotten sick, we're going to work with you to catch up on rent or find a new place and make sure that it's an amicable situation as best we can. Of course, we try to avoid eviction court. Unfortunately, sometimes we do end up there. Repositioning apartment buildings is just part of the business. So by January 2021, we were fully leased at the desired rental amount, and that was ahead of schedule. We expected about a 2 to 3 year process here, but we were able to get that done just a little bit ahead of schedule by about 6 months. So our initial rent roll was $49.20 per month, $4,920 per month. We targeted over 3 years, we could increase that rent to $7,300 per month. In 2.5 years, we hit $7,300 per month. So we hit our goal in just about a half year under our target there. Always good to see. Our construction budget was $20,000. I think that was too light, looking back. So our construction is slightly over budget, but our construction was on schedule. And since we were able to get the project done in a fast period of time, it really just made up for any construction overages there. We also have a targeted 6% annual forced equity growth. That target was achieved, if not a little bit over that. I would say that forced equity growth was definitely achieved of 6% per year, probably more around 8%. So that was good. And of course, we assumed the market would just naturally grow by about 2% a year. Passaic real estate has grown by a lot more than 2% a year, more around the tune of 8 to 12%, depending on what we're talking about. So over the last few years, real estate has done very well. We assumed a natural market growth of 2%, and it's done far better. So that's great for our investors. And it's all about under promising and over delivering, making sure you don't set the bar too high. You can't tell your baseball coach you're going to hit a home run every time you go to bat. You set the bar at an attainable level. We continue to do that project after project with our investor group, and we try to do higher than that, better than that bar. We try and always overachieve on our targets. So here's our total targeted returns for years 1 to 5. Cash and cash return here from the refinance targeted to be at 53%. I think we'll have no problem hitting that, as long as the market doesn't even have to keep doing what it's doing. It could slow down and we'll still hit that. Cash flow on this is incredible. I mean, we assumed a 2% cash flow from this property. That's probably way too conservative. So that's a real number. That's a real conservative projection. We assumed that just these 6 families, they're hard to cash flow on. We also knew we were going into a fully leased building where with rent control, we would need to renegotiate, leases with every tenant, work out cash for keys. We were pessimistic. We were assuming that the building really wouldn't cash flow for the majority of the first 5-year period, but we were wrong. It actually cash flowed pretty quickly. We're producing a cash flow check now on a quarterly basis to this investor, and we'll do much better than that assumed 2% cash flow. Tax depreciation was assumed was 11%. That's pretty easy to calculate, and that is what it was. Our internal rate of return, adding up the cash flow, our refinance there, our tax depreciation, we're looking at about a 66% internal rate of return. That's our target for this investment for our passive investors here. And our cash on cash return, adding up the cash flow and the refinance, is 55%. Total cash on cash return. That's our target for this 1 to 5 year period. And of course, these are 5-year targets. They're not actuals. And again, this is not a solicitation for investment tax advice or legal advice. These are targets we're trying to achieve with our investments for our passive investors here. And it looks like we will achieve them. All right, here's our revenue model. So our passive investors enjoy 3 types of income: quarterly cash flow. That comes along with quarterly, monthly updates and quarterly financials as well, very in-depth financials. So you know exactly what's going on with the property. Annual tax depreciation. That's going to come in the form of a K-1 tax form that's distributed from the CPA firm. We work with a third-party CPA firm there, and they're able to distribute that in a timely manner at the end of the year. So all of our investors get a K-1 tax form at the end of the year. And then, of course, we have the 4 to 5 year cash out refinance. That's the big money maker. That's where our investors enjoy generally a 40 to 50% return on their investment. And that is the goal there. And that's where the investors have the option to exit, get back their initial investment, keep the funds from the refinance, keep the funds from the cash flow. But of course, they'll have to pay capital gains tax on those earnings. So a better tax strategy is to stay invested long term. And that's what most of our investors opt to do. So why now? A lot of people say, why are we buying real estate now? Why don't you just stop buying real estate? The market's overpriced. Yeah, most real estate is overpriced right now. That is accurate. It is really hard to find a good deal. There is no line there. It is really hard to find a good deal. Our biggest challenge is finding a good deal. Generally, when it's found, it is funded very quickly. Rents are growing at a great rate. Interest rates are low. Property values are growing strong. There's a shortage of housing in New Jersey. People need housing. They stopped building housing for a period of time. The COVID didn't help that either. And the housing demand is just growing. There's people moving out of the city saying, wait a minute, I don't need to live in Manhattan anymore. I don't need to live in Brooklyn or the Bronx. I can live in Maplewood or Rahway or Newark or Paterson or Jersey City. or Morristown, or maybe the suburbs, right? So real estate in New Jersey is very strong right now. It's always been strong as far as we've been investing in. And we own our own management company, so we keep very tight control of these assets. And even if the market dips, because markets go up, markets go down, we understand that. We're in a good market right now. We get that. We're making hay while the sun shines. But we also have good assets in good markets that are well managed. And we believe through thick and thin, through recession, through boom times, real estate is a tried and true asset. And we've seen that through the pandemic. Real estate has boomed through the pandemic, where a lot of talking heads were saying, sell your properties, but no, real estate really has done quite well. And so have our investors in the last 18 months or so. So invest with an IRA. Let's talk about how people invest with an IRA in these types of properties. First thing they do is they select an IRA custodian. There's tons of them out there. I can connect you with someone who can help you select the right IRA custodian. If you have a solo 401k, you can also self-direct that into real estate. Once you select the right IRA custodian for your needs, everyone has to have one. Everyone has to hire one to be able to self-direct your IRA. You need to work with a third-party IRA custodian. Once you select the right one for your goals, and if you're not sure of the right one, contact us, give us an email, or contact us through our website, peoplescapitalgroup.com, and we'll connect you with someone who can help you select the right IRA custodian. He has a software that helps you do it. I think it's like $10 or $15 to do it. It's definitely worth the money. So we can connect you with that person, and they can help you, Alan Johnson there, select the right IRA custodian. Once you select that custodian, you're going to have them contact whoever holds your IRA now, fill out the paperwork for however much of your IRA funds you want them to move over to the custodian. And then once the custodian's holding your IRA funds, they can move it into an investment with People's Capital Group. They're going to review the offering memorandum. They're going to review the operating agreement. They're going to review the LLC formation documents and make sure the investment is IRA friendly, meaning it's not an illegal investment for an IRA. We structure our investments just so they can be IRA friendly. They can accept IRAs and solo 401ks because our investors are not essentially on the hook for the mortgage or on the hook for additional cash calls. There's language in there that protects investors in different ways there. So essentially, what we've structured is a nice opportunity for people to self-direct their IRA or solo 401k into professionally managed properties, and not a REIT. It's not a stock that goes up and down with the stock market. It's not through some third-party website. It's a real estate fund out of Berkeley Heights, New Jersey. We've been doing this together, Seth and I, for over 10 years, working with passive investors. And about a third of our investors self-direct their IRA or solo 401k into our projects because they're a nice fit. They're aggressive returns and they're long-term strategies, which are really a good fit for retirement accounts. So let's just talk quickly here about 3 different types of passive investors that work with People's Capital Group, and then we'll wrap up here for the evening and answer all your questions. So here we have a high income investor. This would be an accredited investor, similar to the person who invested $164,000 in the 6-unit in Passaic we talked about. So an accredited investor tends to have large stock portfolios. The dividends from those stock portfolios tend to get taxed as gains. Selling a stock can get taxed as well. The long-term returns are less predictable in the stock market and more recession vulnerable. So we help high-income earners move into real estate, get more tax shelters, work in an asset class that we feel is more recession resilient as we control the property more closely, and everyone needs a roof over their head. It's brick and mortar assets and high demand markets. So we do feel it's more recession resilient than the stock market, and it's more predictable long term. Real estate's a little bit simpler than a lot of the different index funds and things that are so volatile we've seen over the last few years. So, and real estate also offers tax depreciation that stocks do not offer. So that's a huge difference. Real estate offers tax depreciation. Our investors get a K-1 tax form at the end of the year, where someone who owns stocks will not get the tax depreciation to write off their gains on those stocks from the dividends. They can't write off those dividends. So essentially, we also work with another type of investor here, an active real estate investor. This is an individual who owns real estate already. They're running around, maybe managing a management company or managing their own properties. Maybe they own a few properties getting started, a couple duplexes, and they're starting to realize it's a little harder than the gurus told them, but they're interested in kind of seeing how the guys manage big buildings, learning from our updates, getting all the information we provide to explain how we run our business and how we manage these properties. So a lot of individuals who are actually, we also sell properties, we wholesale properties. They'll say, hey, what do you have to invest in passively? I just came out of a flip. I have $100,000. I'd like to put 50 with your syndication. What deal do you have going right now? And we'll talk to them about if we have an investment available. So active investors like us because they don't have to manage the property. They learn from what we're doing to improve their business. They're not on call to deal with all the shenanigans of property management or being the owner of the property. Plus, they're able to now buy more units. So making a $30,000 investment or a $50,000 investment would never get them a 27 unit in Rahway, New Jersey, like we're buying right now for nearly $3 million. But our investors can own part of a 27 unit in Rahway, New Jersey right now for $30,000 or $50,000, right? So they can get a piece of ownership with a smaller investment amount than having to put out, $200,000 or $300,000, or in this case, $1.3 million is what we're raising for the acquisition. So, that limits a lot of investors. So by working with a syndicate, you can get in on ownership of larger buildings, which produce stronger value and stronger cash flow, but not, of course, have to come up with all the capital to do that. And of course, dealing with our CPA and our bookkeeper, dealing with the tax firm we work with, not that they have to deal with it much, but just having access to them. A lot of active investors end up working with the CPA firm we hire for our business because they're so good. And that's just another resource we bring to the table for our passive investors. Okay, here's the third and final type of investor we like to work with. This is a self-directed IRA or self-directed solo 401k investor. We talked about that briefly in a couple of slides back. And essentially, a lot of people are sick of having their entire nest egg in the stock market. We suggest about a third of your retirement account should be in real estate, professionally managed, syndicated real estate, whether that's People's Capital Group or another syndication you trust. We just feel like people should be more invested in real estate, and instead of having their entire nest egg in the stock market. And we preach as well. So we do help people move some of their IRA into real estate to get away from the volatility of the stock market, to get more predictable returns and a more recession resistant investment for their nest egg, to make sure that through the woes of up and down markets, they can still get cash flow and equity growth from their investment. Also, a lot of our IRA investors like making a difference in these communities. Tonight we talked about Paterson, New Jersey. We talked about Passaic, New Jersey. I touched base on some Newark properties and things like that. We're buying a property in Rahway. We like investing in areas that are up and coming. We really like taking a mismanaged property and making it a nice place to live, where it's safe and it attracts good family tenants. And just brick by brick, by improving each building, we do feel like we're improving these cities little by little. Maybe we had a small little thing to do with Newark becoming a better city over the last 10 years, as we've bought and sold dozens and dozens of properties there and renovated them and made them, messed up REO properties into beautiful homes to live in, or mismanaged apartment buildings with slumlords into well-managed professional places to live. And that's a nice feeling to just see your IRA or your hard-earned capital making a difference in Paterson, New Jersey, or Newark, New Jersey, and of course, getting paid from that as well. It's nice to profit from these investments, but also see the difference you're making in these local communities. So we really take pride in that. All right, so that's about it for the evening. Here's some client satisfaction, financially transforming praise. Here's Tim Carey, a 5-time investor. He says, I continue to grow my investment relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. Frank Bacuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. Of course, it's a big point of that. And Chris Salerno, 6-time investor. I've been investing with People's Capital Group for nearly 5 years now. Could not be happier with the process and the returns on my investment. Aaron and Seth and the rest of the crew are fantastic to work with. They are like clockwork in their updates, communications, and payments. A great company. Thanks, Chris. So that's it for the evening. We're peoplescapitalgroup.com. If you're not yet qualified, you want to go to our website here, peoplescapitalgroup.com, and I'll show you what that looks like. We have a ton of information there. We have a podcast called the Passive Cash Flow Podcast. We have over 60 episodes, so check that out. You can click here to view those podcast episodes. We have frequently asked questions. We have an ebook you can download for free, and past webinars we've recorded: how to self-direct your IRA in real estate, how active investors become passive, and how to invest out of the stock market into real estate. So you can check those out on our website. And as you learn more about us, if you feel like you're comfortable and you want to move to the next step and qualify to join our investment group, doesn't mean you have to invest, just means you're going to get qualified to get on that list, be able to review the private offerings we have. You want to go to our website here, click the button qualify to invest, and fill out the qualification form on our website. So if you feel like what I've been talking about tonight is a fit for your investment goals, we talked about the double-digit returns our investors are earning. We talked about our long-term strategy, working with our passive investors, educating them, but also making sure that our investments are protected and profitable with high-demand real estate, and just our overall mindset of believing in real estate, believing in these markets, and owning the management company and being really invested in this market here with our investors for many years and practicing what we're preaching. Then go to peoplescapitalgroup.com and fill out the qualification form, or you can even click here to schedule a discovery call, and that'll allow you to schedule a call with me, Aaron Fragnito, on Calendly here, and we can connect. I can answer more of your questions, figure out if this is a fit for your investment goals. Hopefully it is. All right, so let's take a look at our questions here. Okay. Okay, so our first question is regarding the payouts and how that works. So we talked about the cash flow of the real estate. Cash flow is not the strong point of these investments, right? So these properties produce primarily about 2% cash flow per year or so. The main return on investment is from the refinance, and that's expected to be about a 45 to 50% return on investment for most of our investments. And that allows our investors to then hit that 10% annualized cash on cash return. Okay, so it's a combination of cash flow and the refinance capital. It is a 4-year investment period, but if you add those both up over that 4 to 5 year period, our investors are expected to make about a 10% annualized cash on cash return. And that means if you invest $100, you would expect to make $10 every year. When broken out, when annualized over that 5-year period. Because over a 5-year period, you expect to make $50, okay? There's another question. As far as the Vermont properties, the hotels we buy in Vermont. So yes, those are very popular. That's part of our new acquisitions up here. We're developing a new team, and it's a lot of work. We are developing our infrastructure, our short-term management company up here, which my wife heads. And we are building it at a nice rate. We just bought we're buying a hotel right now, a 12-unit hotel, nice boutique hotel in downtown Ludlow. And those were fully funded in about a week. So most of our investments fully fund in a matter of weeks. And that's the next question here. What's available right now? So let's talk about what's available right now. There is a 27-unit in Rahway, New Jersey. And that's a really nice opportunity, 2 blocks to the train station. Rents are about 30% below market value. One of those deals that I'm very bullish on. I'm very confident in buying it. Of course, we're confident in buying all of our properties, but this one's a real winner. So we're looking forward to closing on this over the next 90 days or so. It's getting funded very quickly. So we're also in talks with some large investment groups right now that really all it takes is one of them to say yes, and then it'll be fully funded and no longer available. So if you want to get in on the Rahway deal or just review the offering and learn more about that, see the financials, get the details of the Rahway offering, go to peoplescapitalgroup.com and fill out that qualification form, and we'll reach out to you, or you can schedule a discovery call and we'll make sure to send you the offering there. So, okay, that looks like all the questions for tonight. So I'm going to wrap it up here. I'm Aaron with People's Capital Group. Hopefully we satisfied your curiosity and talked about how we reposition apartment buildings in New Jersey and how we work with passive investors to do that, and the experience they enjoy along the way. If you want to learn more, check us out on our website, and have a good night.